real quick, I haven't even looked at this yet. This is an email that came through. Unfortunately, I didn't say came through, but it came at the very end from Octavio. And he's got sort of a calendar version position here. He says, can you share your opinion on this transaction, the good, the bad, and the ugly, and how to fine tune for best results? Yeah, I'm not going to be able to go into the fine tuning of this. This is the first time I've seen something like this. But what are we doing for Octavio? I apologize. First, we're entering the proper stock symbol, aren't we? Let's do that first. All right. So Octavio gave us a position on SPY. 16th of August, 5:32 call. So bear with me because we got to go through this whole chain again. 16th of August, 5:32 call. And pause that there so you guys don't see the consistent scrolling. All right. All right, so what are we doing here? We're going to buy a 5:32 call for August 16th. We're going to sell a 5:32 put for August 16th. He gave me the prices. I'm going to stop right there for a moment. So what are we doing? What happens, ladies and gentlemen, when I buy a call and I sell a put? And he's got similar prices to what we saw. This buy contract of the 5:32 call is 624. My apologies, Octavio. And we're selling our 5:32 put for 5:38. What happens? What did we talk about with David? When we sell a put, what do we have? We have the obligation to buy shares of stock at 5:32 if the stock falls below that. Does buying this 5:32 cover that obligation? Absolutely not. What does owning a 5:32 call mean? It means I have unlimited upside, profit potential if the stock continues to go up. This structure here of selling a put and buying a call is a synthetic stock position. Now, it only costs him 86 cents, or 86 cents per contract. And you say, oh, this is so much better than buying stock. Why would I buy SPY right now, 100 shares at $532.99 or $53,000, $53,300, when I can just do this trade and have 86 cents profit? The long call doesn't cover the put obligation. You still have to put up the $53,200 in case your put shares of stock at 5:32. Okay, so you might be using margin, risky. You might have a margin portfolio, but cash secured put wise, you still have to cover. So I still have got 53,286 invested. I'm 14 cents shy of what it would be to buy 100 shares right now. That was the first stage. Now, to reduce the margin requirement, same expiration, August 16th, Octavio is going to buy a 527 strike put, 5 points out of the money, which is what we talked about briefly a little moment ago on those legs of the iron butterflies, the broken wing butterflies. This is creating a bull put credit spread. Okay, so we have the synthetic stock position, okay, where we bought the call at 5:32, sold the put, but now he's going to take some of that premium, that 86 cents premium, and buy a lower strike put at 527. Another way to look at this is I've got a bull put credit spread at 532, sold put, 527 bought put, and an extra long call position. Someone teaches this strategy. It has a name. I can't remember what it is, but someone does, a bull put credit spread with a long call is called the dynamic alien trade, or whatever it is. Someone teaches this. So let's take a look at the profit and loss chart for Octavio as it stands right now to see where we are. All right. So now, really what we're looking at is just a long call position with a cost of 415. Okay, so we did the bull put credit spread. We bought the call. We bought a lower strike put. We have a profit and loss chart that looks like a long call 7 days out in time with a cost basis of 415, which is roughly 2/3 of the cost of buying the 532 call outright. He got a net credit here of what? 210 on the bull put credit spread side. That's what lowered the cost basis. Okay? That margin requirement doesn't exist anymore. Really what you do is you have a profit and loss chart right now, Octavio, of a long call position, or synthetic married put, if you want to look at that. We're going to call it a long put position. Now you're going to go out 98 days out in time, and you're going to buy a deep in the money 555 put. See here, Octavio. Here, Octavio. You've already duplicated the profit and loss chart of quote unquote a married put or just a long call. But now you're adding the extra step of saying, oh, I don't have it. You don't have a synthetic stock position anymore. You have a profit and loss chart 7 days out. That's a long call. That's 2/3 of the cost of the call that you bought. Okay, infinite upside, low risk of only 414. And now we're going 98 days. I'm sorry, I went too far. 98 days out in time to November. And you're saying, oh, well, I created a synthetic stock position and I wanted to protect it as a married put, but I didn't want to buy the stock. I didn't want to do it this way. So I'm going to try to use the synthetic form, but I added the extra put to hedge the margin. And now I'm going to buy this extra put to add extra protection. Well, now you're in a completely different structure, are you? You're not mimicking a married put at all. You're in more of a ratio calendar spread. And so what we've got here, 27. Oh, I'm sorry, your price was 27.73. So I'll give you the benefit of the doubt here. We'll call it 27.55. And I didn't put the right price in for your other bought put either. But in any case, there it is. It's a synthetic long straddle position is what you did. The risk has dropped down to 598. I understand that. Infinite profit to the upside, but the upper break even went up to 542. Lower break-even is at 518. Now, this is at short-term expiration. This is not at November. This is the near-term expiration based on the expected value of the November 555 put with a current implied volatility of 0.155. All right. This structure right here, did you reduce the monetary risk on the position over the synthetic stock position, the synthetic long call by creating the bull put to lower the margin? Yes, you've lowered the risk. Do you keep an infinite upside profit potential? Yes. Lowered the monetary requirement from $53,000 down to $3,700 roughly, about $3,670. Yes, you've checked all those off. You feel that there's going to be movement in SPY now after this big correction, which I don't think is done yet, by the way, but it's going to be more gradual. We're not going to see that sudden drop anymore. Both Ernie and I feel that there's more room for the correction to continue. Down to 518, another 14 points or so from where you are right now, Octavio. So I don't who's here. Let me just take a look real quick at the attendees. Who's here? Mel's still here. Lynn's here. Kenneth is here. Good. Pat's here. I think that's good too. Looking at some of our familiars. Troy's here. That's good too. These are regulars that join our webinars. Any one of those will tell you. Kenneth, Pat, Troy, Kip. When I talk about these positions, seeing this, just like we talked about the iron butterflies and my concerns about, having that profit only 0.2 or 0.3% of the time, although your risk is low monetarily and low against the margin requirement you created, still double-digit risk. Anytime we look at any form of a synthetic long straddle, synthetic long strangle, buying a call or buying a put at these prices, we have to be concerned with what I refer to as no man's land. More often than not, the stock ends up somewhere in this area, depending on market conditions. Now, you might be expecting a great move up, Octavio, now because of what just happened in the last 4 or 5 days in the market. I understand that. You're pointing to a bullish side. This is actually more bearish skewed. You hit break even faster on the bearish side than you do on the bullish. No, not really. I'm sorry about that. It's 10 points up here, 14 points there. Oh, because I'm sorry, I'm looking at your peak. I'm looking at your peak, not at the current stock price. My apologies. Current stock price is here. I was looking at your peak. So yeah, you need just less movement upwards to get to that break-even range, more movement downwards to get into this profit. But if the market just wavers for the next 7 days, you're in no man's land with a 90-day put at 555 that's starting to lose whatever time value you paid into it because it's on the lower end of the time value decay curves. We're talking about 200 here, 150 here, 120. We started the slope at about 90, but 7 days in from now, we're getting into this range at about 60. Not really, I know, but we're getting into 60, and then here we are at 30, and then here we are at 10, and then here we are at 5. So what I'm saying here is if you bought or sold an option, you're paying into the extrinsic or time premium If I buy a 200-day out option, the decay is very slow for the first 150, 160 days, and then it returns rapid. I buy a weekly option, 5 days, 6 days, 7 days out in time. The time decay is very rapid, day by day. Okay, so it's not linear, the time decay of an option naturally. It's logarithmic. And that's why when you're selling premium, you want to be selling here. And when you're buying options for protection, as we do in the married puts, we're out here, 210, 200, 150 days out in time. All right. Fear is no man's land. Okay. Need to be correct in the movement of the market that you're expecting, Octavio. In this case, one thing that, said the pros and cons about it and how to fine tune it. I can't even guess how to fine tune it. We'd have to spend more time delving. I'd have to spend more time. I'm not going to be able to do it, but we'd have to spend more time delving into the deltas and things of that nature. What's your gamma ratio here? And that's not something I like to do on a consistent basis during these webinars. As was mentioned earlier by Noor, hey, you made all these comments about this strategy. It was good, but can you show me a picture of what a butterfly is? Because that's too much. And we didn't even talk about the probabilities, the delta, the gamma, the theta, the vega of those kind of positions. Going back into the different legs that we saw, you wanted to take advantage and use a synthetic stock position instead of buying the stock at 53,000. You would have had to put up the full 53,000 margin requirement, 53,200, for selling that 532 put, because buying call doesn't cover that. You countered that by buying the put and creating a bull put with an extra long call, Octavio, which did what? Gave you a long call position with a cost basis of only 414 versus the initial 635 you would have paid for the at the money call. At this point in your structure, I almost said, why wouldn't you have just bought 2 or 3 strikes out of the money and paid $4 for it? You would have had the exact same structure and probably exact same delta. Why'd you complicate it by selling the put and doing the bull put credit spread, having the 5-point margin between the two? You could have just bought a 533, 534, 535 call at 414. Have the same exact monetary risk than the 3 legs you just entered. In either case, at that point, we had a long call. Now, I talked about the married put, buying stock and buying the put. You took that idea for an extra hedge and bought the 555 November 98-day output and created a synthetic long straddle position, a calendar synthetic long straddle position. You've got 4 working legs now. You've got deltas of the different options, the bought call, probably at around 0.5, 0.51, the sold put at 532 at probably about 0.5, 0.51. Your 525, okay, so I'm sorry about that. You sold the call, so that's a negative delta, even though calls have a positive delta. Nope, strike that, reverse it. Positive 0.51 delta on the call, maybe negative 0.5, 0.51 delta on the put at the same strike at 532. Then you bought the 527 put, which has a lower delta there of maybe only 0.3, 0.35, something along those lines. And then you bought the November put that has a negative delta of 0.65 probably, or something along those lines. So these are close to a wash. And then you bought one put here, which gives you a negative delta of 0.35. This one here at 0.65. But you do have the long call with sold put, a synthetic position with 2 extra puts, kind of like me doing a married put with income method number 12 in the short term, Octavio. You've got to straddle. You got to worry about no man's land in this position. But again, this to me almost looks the same as what if you had just bought the 540 call at 414 and bought the November 55 put with that delta of 0.65, you'd have almost the same profit and loss structure. Why do we need to complicate it with the extra 2 legs just to get the premium? You didn't necessarily need the premium if you're focused on cost. Premium meaning what? Premium of the sold option to create the synthetic. Well, in this case, you did a synthetic, once again, you did a synthetic stock and then you added a put, which means you did a synthetic long call. Why is that necessary? Remember the rules, KISS. How much different is this than just buying a 540 call with a cost of 414? You had almost the same exact profit and loss chart with 1 leg to do it instead of 3. With almost the same exact delta, I bet, of these 3 options compared to each other. Why are we making it that elaborate? So fine-tuning it, delta structure based on what delta, positive or negative, do you want, Octavio, based on what you're looking to achieve on this position, and what you're looking to see in SPY. Are 3 legs necessary just because someone talked about it or someone showed it or because you wanted to quote unquote do a synthetic? Is this actually really better than just buying a call here and then buying this put for the extra protection to create this synthetic long strangle position, synthetic calendar long straddle position? I'm sorry. But with any type of thing we talk about that, you got to be aware of no man's land, where you can lose, where the time value is working against you on your bought call and your bought put. Yeah, it's decaying on the sold option, but you've got 3 bought options, don't you? You've got a long bought put, you've got a short-term bought put for the margin, you've got a bought short call, shorter term. You're staying in no man's land longer and longer. Yeah, you're getting premium on decay on 1, but you're losing on 3 bought values. That's what we always talk about when we talk about long straddles, long strangles, synthetic positions that create this V or U profit and loss chart. You've got to be aware of no man's land. I know you're expecting us to continue to move maybe direction downwards or a sudden spike up after the market conditions, and that's why you're in this structure that is a low risk, but still double digits of what you invested. And we'll talk about that more related to the martingale later on this week. We won't have time to cover it today. Why the married put is important to cover risk to single digits. The risk of gambler's ruin. When you start going to a 25% loss, you need a 33% gain to get back to break even. I have a 10% loss. I need an 11% gain to get back to break even. I have 15% loss. I need a 21.5% gain to get back to break even. But if I take a 5% loss in a controlled structure, proper risk control without trying to complicate it with the synthetics or the leverage positions of a long call, if I take a 5% loss, I only need a 5.3% gain to get back to break even. Okay, and that's why the proper structure comes into play. I see what you're doing. You created a married put synthetically. If we took this out, took the bull put portion out, this extra 527 put out, we'd be looking at sort of a synthetic married put position with a controlled risk of 541 or 19% against the investment on the synthetic. Okay, this would look like a calendar put spread to your broker with an extra long call. That's why it's not really showing the skewed lower floor, Octavio. But you did that extra put. That created the synthetic straddle position essentially with 4 legs. I feel you probably could have done it with only 2 legs. That's my concern. How to fine tune it? Well, that's based on your market conditions. You can skew that any way you want. So fine tuning it is more based on what you want to see. My concern, why I'm in fine tuning it, your term that you mentioned, is me not only saying that, oh, well, we could adjust the short put this way, the long call this way, we could adjust the bull put credit spread this way, we could look for a lower probability, we could separate the strikes. I'm not getting into that, Octavio, because I'm just saying, if we just looked at what your delta was to fine tune it, you could just say, let's take these 3 legs out and let me just buy a 540 call to match the same delta and possibly even Vega and have the long put if that's the profit and loss chart you want. Customize it or fine tune it, that way, Octavio, based on what you're at. If I'm bullish, I want more of a positive delta. If I'm bearish, I want more of a bearish delta with that November 555 put in play. What is your SIGA model, as we talk about in the blueprint? The current conditions, your expectations, your goals, that determines your action. That's going to help you fine tune it. I'm concerned that you're overcomplicating this because it looked to you that, hey, I can use less money by using a synthetic. Okay, but you could also do less steps by just buying a long call instead of doing the synthetic stock of buying a call and selling a put, then adding any extra put to create a bull put with a long call. You're still in just a long call position with a delta that's probably equal to the out of the money long call and equal to the price of the out of the money long call. And you do that with 1 step instead of 3. It's going to react essentially the same in those first 7, 10, 15 days to the November 555 put that you bought.